So this was my attempt to explain the market and the plan to attack it to a colleague yesterday. He left satisfied, but I promise to try to make it a bit more clear for you. So I'll quickly get rid of this page as I walk you through a few key things I want to cover this week. Number one is the 4 typical phases of a bear market and a recession economy, where we're at currently, and see to the biggest risk to investors. And then again, a plan of attack, really how we should be best using our time and attention. So let's start with the 4 phases of a typical bear market and recession. So basically it looks like this. Panic, phase 1. We obviously saw this in the first few weeks of March. Again, not very atypical, except for how steep this one was, record-breaking. Only the crash of 29 really could match it in terms of its magnitude in depth over such a short period of time. Then very classically, you get a bounce, phase 2. So this is the all clear, the over-optimism, people trying to bottom fish, typically comes in at about 50% of whatever the drop is, which is close to what we're at right now. This one's a little bit different in the sense that the Fed has intervened like it never has before, quite literally buying ETFs, which is a first and quite possibly illegal for that matter. Phase 3, though, is acceptance of reality. So what I see really happening and want to make sure you're all prepped for is that a lot of the optimism, which is great from a public health perspective around the COVID-19 cases beginning to roll over, and the market's clearly been focused on that, are going to give way to some of the economic carnage that has occurred during this 2-month and counting shutdown. So what you typically again then see is a phase 3. This quite often at least tests the prior lows. Whether or not we get there, as I shared with you last week, is going to be highly dependent. The Fed is a factor. I don't think that they can get rid of economic gravity. They might be able to bend it. And so exactly how that retracement looks, again, is subject for debate. I would just caution those that think it's going to be up, and away. That probably isn't the case. And then there's phase 4. Phase 4 can have another recovery and decline, but usually phase 4 is, for a bear market, is just something between despair and frustration, that things aren't happening as people hoped in phase 2. That's what I want to have you prepped for. If it's up and away from here, that's great. It's just unlikely, and I don't want, again, you to get too frustrated or, again, embrace too much despair in this phase 4. So with that, we'll cover the rest of the material. So where are we at today? Well, as I just hinted, we're walking through that chart. We're likely in phase 2 still, but soon to be heading into that phase 3, phase 4. And really phase 2, again, is defined by over-optimism. The reality is we're going to have a hard time just going right back up to those all-time highs for a few reasons. Number one is what those all-time highs really represented. What in February, when we were sitting at 3,400 on the S&P, that was in the top 10% of most expensive markets of all time. The justification from that, even amongst bulls, was, yeah, but there's going to be a global synchronized recovery. The green shoots of economic growth are appearing around the world. Well, that's hardly been the case with a global shutdown now of 2 months. And yet, if you look at today's valuations, even with earnings that haven't probably come down enough in terms of estimates, the market with this rebound is now trading at even higher levels from a valuation perspective than it was in February of 19. And that, coupled with the fact that we don't think this is going to be anything near the V-shaped recovery that we had hoped for when we were talking about a 2-week shelter in place, means that people are probably a little bit out over their skis who are allocating new assets into stocks right now. So what, again, is some of that specific data? Well, one thing you want to keep in mind in terms of timelines is from those types of valuation levels, typically recessionary bear markets have pulled back 50 to 90%. I think the Fed's intervention has taken that off the table, but they've lasted anywhere from 12 months to 12 years in terms of recovery periods. So the idea that we're going to last something even less than 12 weeks strikes me as pretty implausible, no matter what the Fed tries to do or the federal government tries to do to suspend economic gravity. If you look at, again, some of that data, unemployment at 22 million and counting, estimates continue to come in at probably north of 30% unemployment before this is all said and done. And upwards of 2/3 of those unemployed likely to go back to work in the next 12 months. That is something I do not believe the market is priced in at all. No matter how much you love your favorite FANG stock, the idea that Apple is going to sell as many iPhones, Google is going to sell as many ads with double-digit unemployment stretches the imagination. You look at just general production, whether it's the Empire State Manufacturing Index or industrial production, the readings this week, which don't even reflect April type readings, but again, a partial opening in March, are twice as bad as the worst reading we saw in 2008. And earnings reports to date down 30%. And again, that's for a quarter that was still 2/3 open and normally functioning. So a lot still to work through on the data front. On the more anecdotal level, managers are split. You've got fame managers like Dalio and Costin and Larry Fink telling you that they think a bottom is likely in. On the same side, you've got Goonlock and Mobius and Rosenberg and other people who are genius managers in their own right telling you they think we'll retest those lows. All that's to say nobody really knows, and you don't have to feel the pressure to know either. The one person who may know, Google, had a memo leaked this week that said they're preparing for a 2008 type economy for the foreseeable future. If anybody knows, it may be them. So before I've completely freaked out my bears or my more pessimistic viewers, just want to reassure you, again, that Federal Reserve intervention, government intervention likely does take a lot of those worst case scenarios, both economically and market related, off the table. And these times are not permanent. We will work through them. All that's just to, again, try to balance out those emotions, prepare you for what lies ahead in terms of those 4 phases. And with that, again, and last point here, be emotionally and financially prepared. On the emotional level, really define what it is that you're fearing and what loss really looks like. Your account being down temporarily for a point in time is not loss. What is loss, as we talked a little bit about last week, is moving into assets that can't even keep up with inflation. It's moving into assets on a more permanent basis that can't keep up with the long-term averages of, again, more normal assets, stocks, real estate, et cetera, that are there to help power those dreams that, again, you feel like might be slipping away. All that's still very much within reach. Those 4 phases don't stop that, but you've got to, again, define that fear, put it to aside, and move forward with that plan. And that plan, again, needs to have income. It needs to have assets, whether that is cash or conservative fixed income that can hold up in these types of markets. And lastly, a plan and a partner to help you stick to that plan to opportunistically buy to get back to even sooner rather than later. In summary, this is a journey that is not going to be quick, but it doesn't need to be feared or fatal. In fact, it can lead to a much better place if you've got the right mindset, if you've got the right plan in place. I want to thank so many of you for entrusting us to walk that journey with you. And for you, your loved ones, or anyone else, know we're here anytime to talk. Thanks so much.